Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
And yeah, if you're checking your portfolio this Friday, you definitely know that the market mood has shifted pretty dramatically, actually. Volatility is back.
It really is. And it's not subtle this time. So today we've pulled together a deep dive looking at reports from, the majors, CNBC, Reuters, Bloomberg, Yahoo Finance. We want to try and figure out what's truly driving this fear.
It's interesting because it feels like we're not just dealing with one issue, right? It's more like several big things hitting at once.
Exactly. You've got the incredible promise of AI butting up against these kind of brittle market structures. Then there's this big geographical shift in assets moving away from the U.S.
And underpinning it all, you have these intensifying geopolitical frictions, the chip wars, trade tensions. It's all connected.
The fear is definitely measurable, isn't it?
Mm.
Looking at the snapshot from Thursday.
Yeah. Oh, absolutely. Sources like Bloomberg were pointing out overnight Thursday, the NASDAQ sank, 1.9%. That puts it on track for its worst week since early April.
Wow.
And the VIX, the SIBO Volatility Index, that really jumped. It's sprinting towards 20.
Okay, so that VIX jump tells you stability is fading fast. Investors aren't just selling, they're actively hedging risk now. That feels like a real shift.
It does. It signals a different kind of concern is taking hold.
So let's start right there with the AI valuation alarm. And tied to that, this huge concentration risk we see in the U.S. market. The bubble warnings are getting louder.
They really are. And these aren't just whispers. CNBC highlighted this week, you've got the IMF, the Bank of England Governor, Andrew Bailey. They publicly warned about an AI bubble because of stretched valuations.
Serious institutions raising flags.
Exactly. You can't just dismiss that kind of institutional worry.
And then David Solomon at Goldman Sachs, he put a number on it, predicted a likely 10 to 20% drawdown in equities sometime in the next couple of years. That's quite specific.
It is a serious warning.
Yet we also read some experts, like Kiran Ganesh at UBS. They acknowledged the wobble, but still seem broadly positive on the AI story long term. So how do we square that? Is this just noise, or is the risk real?
Well, I think the risk isn't just the valuation itself, it's the structure. That's what we're seeing in the source material. We're talking about massive concentration risk, especially here in the U.S.
Right.
Like one expert pointed out to CNBC, the Magnificent Seven stocks, Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, Tesla, they now make up around a third of the S&P 500's entire market cap.
A third. So is the whole U.S. market basically acting like a giant big tech ETF now? Is that the real bubble risk, the concentration itself?
That's the critical question, I think. You're concentrating so much risk in just three very cyclical sectors: IT, communication services, consumer discretionary.
They get to cold.
The whole S&P 500 sneezes, exactly. Now, compare that to Europe. Our sources show the top 10 names in this SDXX Europe 600. They're only about 17% of its market cap.
Much less concentrated.
And much more diversified, spread across healthcare, energy, financials, consumer staples. The risk is just spread out way more over there.
Speaking of the Mag 7 and concentration, we have to touch on Tesla. Yahoo Finance and Reuters confirmed shareholders okayed Elon Musk's, well, frankly, staggering $1 trillion pay package.
Yeah, it passed with 75% support, and it's tied to these, moonshot goals. We're talking an $8.5 trillion market cap, 20 million vehicles delivered.
And the aerobotics piece is huge. 1 million robotaxis, 1 million Optimus humanoid robots. It's an enormous bet on AI execution.
Absolutely. Over the next decade, it really hinges on that.
But that kind of AI ambition immediately slams into the chip crunch, right? Reuters reported Musk saying Tesla will likely need its own gigantic chip fab. He called it a Tesla terafab.
Right. He basically said even if current suppliers like TSMC and Samsung do everything perfectly, it's still not enough for their future AI chip needs.
Wow. So they might need to build it themselves, maybe with help.
He mentioned possibly partnering with Intel. But think about the implications. When a company like Tesla feels it needs to vertically integrate into making semiconductors just to secure supply.
It tells you everything about how intense this AI race is and the limits of current chip manufacturing capacity.
Exactly. It's a huge structural point.
Okay, so that structural risk in the U.S., the Mag 7 concentration, this high-stakes ambition, it leads perfectly into our second big theme.
Yeah.
This global investor pivot away from U.S. assets.
Yeah, this trend people are calling, the Trump dump or sell America or even ABUSA, anywhere but the USA.
Catchy names.
They are. And according to CNBC, this trend really spiked back in April after some U.S. tariff policies were announced. U.S. stocks have rallied since, sure, but the underlying pressure seems to be building again, especially with international money managers.
So why are they hesitant about the U.S. now? Our sources seem to point to two main drivers.
Right. First, just basic portfolio construction. The U.S. market is so huge that many global portfolios are already kind of naturally overweight U.S. stocks. They just have enough exposure already.
Makes sense. And the second?
The second is, well, let's call it investor discomfort with the U.S. political or governmental direction. Experts are definitely noting that as a factor.
And this isn't just talk, is it? It's showing up in the performance numbers.
It really is. Look at the MSCI World ex-USA index that tracks developed markets outside the U.S. It's up a massive 24% year to date.
24%.
Mm-hmm.
And the S&P 500?
The S&P 500 is up about 15.6% year to date, so a pretty significant outperformance for the international index.
Okay, so nearly a 50% greater return internationally.
Yeah.
But then you add the currency factor, and it gets even more dramatic for overseas investors, right?
Mm-hmm.
CNBC had that analysis from Calus Investments.
Yes, that really highlighted the double whammy. Think about a European investor. They're at, say, 14% gain on the S&P 500 this year. It got knocked down to a net return of only about 2%.
Only 2%.
Because the euro appreciated about 12% against the U.S. dollar over that period. The currency move basically wiped out almost all their stock market gains when translated back to euros.
Ouch. So if they just stayed invested in local European markets, they'd have kept the local stock return and benefited from the stronger euro.
Exactly. That kind of math makes local markets look much more appealing for new money. It's pushing capital overseas.
It's a really compelling case for diversification right now.
It is. Now, we should probably note, not everyone frames it as an outright sell America. Some risk managers, like at Chatham Financial, they talk more about hedge America.
Okay, so maybe not dumping everything, but definitely reducing exposure or hedging.
Yeah, but the underlying point is similar, that sort of unquestioning faith in U.S. market dominance seems to be fading a bit, and global investors are actively looking for alternatives.
Which only gets more complicated when we bring in our third major piece, these geopolitical headwinds, especially the U.S.-China tech fight over AI chips.
Yeah, the pressure is definitely intensifying there. Reuters confirmed the White House is blocking NVIDIA from selling its latest scaled-down AI chips, things like the B30A to China.
And the top-tier stuff, like the Blackwell chip.
NVIDIA's CEO, Jensen Huang, said there are no active discussions about selling Blackwell to China. So that effectively cuts China off from the most advanced Western AI chips for their biggest projects.
So what's China doing about it? How are they responding?
Well, CNBC had a really fascinating piece on China's counter strategy. Since they can't get those top-end, super-efficient NVIDIA chips, they're relying on just massive clusters of their own domestically produced Huawei Ascend chips.
Okay, so replacing efficiency with just sheer volume.
Pretty much. We learned that one system, the Huawei Cloud Matrix 384, it connects 384 Ascend chips to try and match NVIDIA's best systems. But it takes about 5 times as many chips to get comparable results.
5 times the chips. What does that mean in practice? Latency. Power.
Both. Definitely higher latency and significantly higher power consumption. China's trying to mitigate the power issue by leveraging its, quote, abundance of cheap energy. They have invested massively in solar, wind, nuclear, plus they have local government subsidies.
So it's a strategy that works within China, politically and geographically, but it sounds more expensive and maybe slower. Could create a tech gap.
That's the risk, yes. A potentially widening technological gap with the U.S. in cutting-edge AI development, driven by these hardware limitations.
And this chip rivalry feeds directly into the trade picture, doesn't it? We saw some new data this week.
We did. CNBC reported China's exports actually contracted unexpectedly in October, down 1.1%. That's the first drop in almost 2 years.
And a big part of that was trade with the U.S.
Yeah, shipments just to the U.S. plunged 25%. Which is striking, especially since it happened despite that recent sort of trade truce agreement between the leaders.
But China is managing to diversify elsewhere.
Seems so. Shipments to places like ASEAN countries, the EU, Africa, those are surging, so they are finding other markets.
And meanwhile, China keeps hold of its leverage points, like rare earths. Reuters noted they're designing a new licensing system, maybe to speed things up a bit.
But industry insiders are apparently skeptical. They don't think it'll be a full rollback of restrictions. China likely wants to keep that card in its hand in the ongoing trade rivalry.
Makes sense.
Okay.
Okay, let's wrap up with these other market puzzles adding to the anxiety. starting right here at home with the fog from the U.S. government.
Right, this lengthy U.S. government shutdown, it's now, 37 days. And as CNBC pointed out, it's delayed critical economic data releases, like the non-farm payrolls report, for the second month in a row now.
So investors are flying blind on the official job numbers.
Pretty much, which is why everyone's hyper-focused on any private data they can get. Like the Challenger, Gray, and Christmas survey, it showed October job cuts spiked way up to over 153,000.
That sounds high.
It's the highest October level since 2003. And the tech sector saw the biggest share of those cuts. So you see data points like that, and with the official picture totally dark, it just adds to the uncertainty.
And in that data vacuum, every word from the Fed gets magnified. We heard from New York Fed President John Williams.
Yes, according to Reuters, he commented that the Fed, having recently stopped shrinking its balance sheet, might actually need to start expanding it again soon through bond purchases.
Expanding. So stimulus, QE again?
No, he was very clear on this. It's about addressing diminishing liquidity in the banking system, moving reserves from somewhat above ample back towards just ample.
Okay, so it's just plumbing, not policy change.
Exactly. He stressed it's routine reserve management and, quote, in no way represents a change in the underlying stance of monetary policy. They're just making sure the financial system has enough, lubrication to run smoothly, not turning on the economic boosters.
Got it. Okay, shifting from Fed plumbing to another central bank headache. Let's look at Japan. CNBC reported Prime Minister Takaichi is facing a pretty tough challenge early on.
Yeah, real wages in Japan have fallen again. For the ninth straight month in September, inflation there, running at 2.9%, is just eating away at purchasing power.
So that puts pressure on the Bank of Japan.
Intense pressure to finally raise interest rates, which is a direct challenge to the long-standing low-rate policy, the sort of Abenomics approach that Takaichi seems to favor.
So you've got this tension building between the government wanting low rates and the central bank facing pressure to hike because of inflation hurting regular people.
Exactly. It's a classic political versus central bank showdown brewing, driven by that erosion of real wages. Quite a contrast to the U.S. focus on AI valuations and data blackouts.
So wrapping this all up,
Yeah.
what does this deep dive tell you, the investor? Heading into the weekend, it really feels like the market is caught in a tug of war.
It absolutely does. You've got the incredible, almost intoxicating promise of AI on one side, but on the other, you have the severe concentration risk, especially in the U.S. market.
And layered on top of that, you've got intense geopolitical friction, particularly in chips and trade, plus this fog hanging over the domestic economy because of the government data blackout.
I think the really crucial takeaway here is this potential structural shift away from just assuming U.S. asset dominance. The evidence for international diversification is getting pretty compelling right now.
Well, based on performance, like
Right.
that MSCI World ex-USA outperformance.
And driven by pure currency mechanics, as we saw with the European investor example.
Yeah.
So the provocative question maybe is, will this shift away from U.S. assets gather more steam in the coming months? Or can the domestic AI rally somehow continue to just power through and overshadow these, frankly, quite significant global concerns and diversification arguments?
It really feels like a major pivot point for how global money gets allocated. We'll have to keep a close eye on it.
Absolutely.
We'll see you all Monday morning with new headlines from major financial magazines.